Hello everybody, this is Chris Robbins from Grand Street Wealth Management, and today we're going to talk about the importance of rebalancing. As always, you can go to grandstreetwm.com and click on blog to see all of our previous articles and videos. So rebalancing seems pretty counterintuitive to most people. Basically, by rebalancing, we're going to be selling the assets in the portfolio that have been doing the best and buying the assets in the portfolio that have been doing the worst. And depending on the type of market we're dealing with, either a nice bull market or a scary bear market, fear or greed has a tendency to rule your decision-making process. So rebalancing kind of forces you to buy low and sell high, and vice versa. So let's look at an example to try to illustrate this point. We'll look at a portfolio made up of 50% of the Russell 3000 index, which is basically the total U.S. stock market as an index, and 50% of the Barclays Aggregate Bond Index, which is basically the U.S. bond market as an index. One of these portfolios we will rebalance every 12 months, and the other one we will never rebalance. And we'll examine it over the last 15 years from September 1998 through August of 2013. So as the tech sector took off in the late 90s, we would have been pretty happy we never rebalanced. Up here at the top of the market in August of 2000, our non-rebalanced portfolio is up about 51%, where our rebalanced portfolio is up only about 35%. And the reason for this is pretty simple. Along the way here, we've sold some stocks, bought more bonds, sold some stocks, bought more bonds. And because our stocks have been doing so well, and we sold our stocks along the way, it hurt our returns. But one thing it did do for us is it kept our risk constant. So here at the top of the market, our portfolio is still about a 50-50 portfolio. And by 50-50, I mean 50% stocks, 50% bonds. Up here on the never rebalanced portfolio, we've actually concentrated our risk in stocks. Our portfolio is actually pretty close to a 60-40 portfolio now, with 60% of our assets in stocks and only 40% of them in bonds. So what that means is that as the technology bubble bursts in mid-2000, our non-rebalanced portfolio actually suffers a greater loss over time. Because now this 60-40 portfolio up here is concentrated in stocks, we have a much greater loss over time. Now, neither of these two portfolios did fairly well over this time period. Our non-rebalanced portfolio is only up about 4% over that time period, and our rebalanced portfolio is up about 15%. But just like this portfolio was concentrated in stocks up here at the top of the market, our non-rebalanced portfolio is actually concentrated in bonds down here at the bottom. In fact, our portfolio is actually a pretty close to a 40-60 portfolio down here at the bottom of the market. So as you can probably imagine, since we are underinvested in stocks, as the market recovers in the mid-2000s, it takes a long time for that non-rebalanced portfolio to catch up. So since we own not enough stocks, we own more stocks down here at the bottom, we actually have a much better recovery. Now, since along the way we've sold some stocks, sold some stocks, sold some stocks, and bought more bonds, eventually that non-rebalanced portfolio did catch up to our rebalanced portfolio. But as you can probably imagine, once we get back up to the top of the market here, the financial crisis of 2008, 2009 is looming, and we're much more concentrated in stocks. And as you can probably imagine, during the financial crisis, our non-rebalanced portfolio underperformed our rebalanced portfolio. Now, they both didn't do very well, but the non-rebalanced portfolio lost about 37%, while our rebalanced portfolio lost only, and I say only because relative performance during that time was everything, lost only 25%. And as you can probably imagine, down here at the bottom, we have a problem again. We are underinvested in stocks once again, since we never rebalanced. Down here at the bottom, our rebalanced portfolio, we actually sold some of our bonds and bought stocks along the way. Our non-rebalanced portfolio, we never really did. And in fact, our portfolio is a 35-65 portfolio. And as the market recovers, as you can probably imagine, since we're underinvested in stocks, our rebalanced portfolio ends up outperforming. And depending on what happens here in the future, the non-rebalanced portfolio may catch up, or if we have another big drop in the market, our rebalanced portfolio will keep gaining ground on our non-rebalanced portfolio. Now, the example I just went through kind of illustrates what some people call the rebalancing bonus. And basically what that says is that during volatile markets, a properly rebalanced portfolio can actually earn a higher return than the weighted average of its parts. So our rebalanced portfolio over that time period earned 6.38% per year, where the Russell 3000 over that time period earned 6.22%, and our bond index earned 5.36%. Now, if we were to take these two numbers, divide them in half, and add them together, we would get the annual return of our non-rebalanced portfolio of 5.79%. So by rebalancing, our rebalancing bonus in this case is about, 60 basis points or so. Now, this isn't always the case. I mean, if a market, just like we saw how that non-rebalanced portfolio caught up, if a market is just keep going up, 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 and over long periods of time, like if you look back from like 1927 to 2013, a non-rebalanced portfolio did, in fact, outperform because stocks have done pretty well over the past, 80 or 90 years. But it's not about getting extra return, although that is possible in this situation. It's about controlling risk. As a quick aside, I think it's interesting that a 50-50 portfolio like our rebalanced portfolio actually did better than an all-stock portfolio made up of the Russell 3000 over that time period. And if you're interested, here's a chart of the two, with the blue line being the rebalanced portfolio and the red line being the Russell 3000 index. You can see the Russell 3000 real volatile up and down the whole time, where the blue line is a much more stable growth over time. And it actually outperforms while taking much less risk. So as I mentioned, it's all about controlling risk in your portfolio. And the most likely situation is that as stocks do well, your portfolio will be concentrated in stocks. And if you don't sell them to rebalance back in the bonds, you could have larger losses than you could be expecting. Now, at Grand Street Wealth Management, we don't use a calendar approach to our rebalancing. We use what we call rebalancing bands. And we allow more volatile assets to fluctuate more than less volatile assets before we actually hit targets. But a good rule of thumb is what I call is what's known as the 5-25 rule. So what that means is, let's say we have a portfolio of a 60-40 portfolio. So 60% stocks and 40% bonds. So if we take the stock portion of it, if we're going to look at major asset classes like this stock bond portfolio, that's where the 5 comes in. So we'll allow this 60% of stocks to fluctuate between 55% and 65%. Once we get to either one of these limits, we'll sell some of our bonds and buy more stocks, or vice versa, in order to get back to our 60-40 portfolio. The 25% rule comes from within an asset class. So let's say that that 60% is broken up into 30% U.S. stocks and 30% international stock. We'll allow each one of these asset classes to vary plus or minus 25%. So that would mean we would allow U.S. stocks to go between 22.5% and 37.5%. So if our U.S. stocks got outside of this limit, then we'd rebalance back by maybe buying more international stocks or emerging market stocks or whatever else was inside of this stock asset class. That's a good general rule of thumb. Some other rules of thumb to do when you're thinking about rebalancing is that you want to use new cash first to rebalance. So if the market's been on a tear like it has been lately, when we get new cash into the account, we're going to want to put it into, say, emerging market stocks or safer bonds to try to get those assets back up closer to their targets before we actually have to sell something to buy new to sell assets to buy the ones that are underperforming. If we're dealing with taxable accounts, meaning not 401k type accounts, but actually just regular after-tax brokerage type accounts, we want to try to avoid short-term capital gains whenever we can. So if you have an asset you've held for 11 months and it's time to rebalance that, it may make sense to wait the extra month to get it to a long-term capital gain status before you sell it. If you do have to take capital gains, it may make sense to just rebalance to the lower range of the limit instead of the actual target allocation. So like in the example we just used where we allow US stocks to fluctuate, maybe if it gets up to, if our limit was 37.5% and it got up to 40, maybe we only rebalance back down to 37.5 instead of going all the way back down to 30 in order to take less capital gains. And if we're going to rebalance, we should think about rebalancing inside of our tax-deferred accounts, such as our 401k accounts, because we don't have to worry about capital gains in that equation. Well, that's it for this week. Hopefully you guys learned some more information about rebalancing and why it's important, and we will talk to you again soon.